And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. I'm your host, Lance Roberts. It's hump day, of course, as we kind of grind through this first trading week of August. And man, what a beginning of August it's been, right? I mean, just already had a crash and it's all kind of fun. So yesterday, of course, we talked a little bit about the fact that this, kind of yen carry trade, and we have an article posted on our website. Again, if you don't understand what the yen carry trade is, just go to realinvestmentadvice.com. The article on the website is right there for you. But the important thing here is that was that shock, that unexpected exogenous event that showed up and kind of rattled sellers in the markets. Now, the question is it over, right? This is going to be the big question. Is all this over and behind us, and are we now kind of back out of the waters? I think it's too early to say that just yet, but the Nikkei, which is the Japanese stock market, has recovered back to where it was on Friday. It's had 2 huge days of rally so far. Pressure on the yen is coming down. The Bank of Japan today came out and said they're not going to hike rates. So this all started, by the way, when the Bank of Japan said they're going to hike rates. That's what all of a sudden caused this whole spike in the yen and created this problem with the carry trade. Well, of course, the Bank of Japan has now backed off of that, said, no, we're not going to hike rates here. And that has alleviated that pressure. The yen is coming back down. The Nikkei is rallying. That's pulling that pressure off the liquidation of the carry trade, which was basically, short the yen, long U.S. Treasuries. So that pressure has been taken off the markets. Markets rallied a bit yesterday. And they're looking to open up this morning some more. Now, this morning we've also got earnings reports coming in from a lot of companies. Super Microcomputer reported last night. This is a very interesting company. It got linked to the AI trade. They build computers. And they were a mid-cap company that surged in price by a couple of 1,000%. I mean, it was just a huge rocket higher in price. And as that stock went up, the S&P company, S&P Global, said, hey, let's pull that into the S&P 500. That was right at the peak of the stock market price for Super Microcomputer. Since then, it has declined, and this morning it will open down about 11-12% this morning after reporting earnings last night. They beat on revenue, but guidance was really, really bad. So that's going to really kind of weigh on that stock this morning. But again, overall, outside of that kind of one event, the rest of the tech sector seems to be kind of healing up here a bit. But again, as we talked about yesterday, be careful here because it's a little too soon to think that maybe the bottom of the market is in. Now, this is going to provide a buying opportunity at some point here. We'll be able to use this correction to add into positions and those type of things. But just be a little bit careful here, and we'll talk some more about this in just one moment. Outside of that, economic data remains okay. If you take a look at the Atlanta Fed GDP now, which is the real-time economic tracker, it is at 2.9% for the second quarter. So, a lot of talk here recently, different videos, different channels, et cetera, about, the recession's here, the Sahm Rule triggered, this means recession is certainly upon us. We're still at 2.9% growth. According to the Atlanta Fed, GDP on a nominal basis is still running right around 3%. So understand that in order to get from where we are to recession, we have to reverse 3% of nominal economic growth. And this is one of the mistakes that people make. They get too overly concerned. They start making bad investment decisions. We still have economic growth going on. It is slowing, right? It is slowing down. There's no doubt about that. But it's going to take a while. It's not going to go from 3 to negative in a quarter, right? Now, it could, but you're going to need some type of real kind of severe economic crash to do that. But right now, given that we're still generating jobs, less jobs, but still generating jobs, we have less wage growth, but we still have wage growth. All those type of things are giving the economy some support. So there'll be a gradual decline. We'll eventually get to a recession, but it may not be as soon as a lot of people are trying to scare you into thinking. So again, this is why it's important. Keep a watch on that data. ISM services on Monday, back in expansion territory. That's giving the economy some support here near term. So again, that's going to help support earnings in the meantime, and potentially give the market some support as well. So again, be careful with narratives. That's kind of the big message as always. Okay, let's talk a little bit about what you need to know before the bell this morning. Is the crisis over? That's the big question we all want to know. Yesterday, market rallied nicely. We kind of bounced off that low from Monday during that 3% down day. Of course, had a big drop there. Rallied a bit yesterday, rallied right into the 100-day moving average. And so this was that first test of resistance that we had at the 100-day moving average. And as we said yesterday, there's a lot of trap longs in the markets, right? People that got swept up into this, this sell-off looking for an exit. So we rallied to the 100-day yesterday. Sellers showed up almost immediately, started selling the market. Market sold off here a bit yesterday into the close. Still finished positive for the day, but well off the high of the day for certain. This morning, futures are pointing up again. We're going to try to open up again this morning. So we're going to try to retest that 100-day moving average one more time here. Now, if we get above that, that's going to set the market potentially up to a rally of the 50-day, where the 20-day moving average is now starting to coincide with that. So there's going to be a good bit of overhead resistance if we can get back to the 50-day. That's possible, but the least possible probably right now. The 100-day moving average is probably going to be the big resistance challenge for the markets over the next few days. Now, importantly, we've got this potential of this rally here. And again, I would suspect that, and again, if you go back and look at previous corrections of the market, and I'm talking about these kind of, out of the blue corrections, like the fat finger crisis back in 2010, the 1987 crash, etc. All of those crashes like that, they rallied, they retested lows or set slightly higher lows before that correction process was over. And we saw this in 2015, we saw it in 2018. So a retest of somewhere in this kind of lower area of the markets, and again, even the 200-day moving average, because the 200-day moving average is going to continue to catch up here with the markets over the next week or two. So somewhere between that recent bottom that we set yesterday and that 200-day moving average is likely going to be where this market tries to find an ultimate bottom. Again, we've got to get some of these trap longs out of the markets. So as we kind of rally, we stop getting met with sellers every time this happens. So the point here is be a little careful it's okay to try to nibble at some stocks that got really, really beaten up. If you don't own them, it's okay. And you want to take a small position in them as a tester, that's fine. Just realize that you may wind up losing some money in those positions in the near term before you find an actual bottom in them. So if you're going to make a bet here on a company, do the work, do the research, right? Do the fundamentals, but be willing to lose a little bit of money on that position, waiting for that ultimate bottom to be set. Because again, whether it's Nvidia or Apple or Microsoft or any other company, likely we're going to see some selling come back down, retest that low before we actually see the ultimate bottom. That's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff. Is the Fed behind the curve? That's the big question that everybody's kind of been talking about lately. We'll talk about that with Danny Ratliff right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me as well. Good morning, Danny. How are you?
Good morning. Doing great.
Are you really?
I am.
After 3 days of turmoil, you're still hanging in there, huh?
I'm here. I'm here.
It's always interesting.
Well, it is always interesting, but I think, the way that, being proactive, doing things along the way, I think certainly helps. And also just communicating in other ways as well. You did a really good job on Monday, sending out a great video, kind of explaining what's going on. I found not a whole lot of people understood the yen carry trade.
Right.
And so that's really helpful to kind of put it in perspective. And right now we have so much information coming at us, right? This political turmoil, all the rest of what's going on in the world, geopolitical tensions, not to mention just a market that's ran up. Participation's been relatively poor. And we've seen some bright spots, but the headlines are what's catching everybody, and I think catching them by surprise, or maybe not by surprise, but I think worrying and giving people concern.
Right. Well, and again, it's stuff like this, and as we talked about before, here on the show numerous times, is that we worry about all these things. Brent put a note on my calendar this morning. It says, I'm literally fine as I don't think about the past or the present or the future. But there's all these things that we're constantly worrying about, right? Israel and Iran, or China, Russia, Ukraine, the debt, the deficits. And as we've said here on the show so many times, is like, if you know about that and if you're worried about it, that's not the thing that's going to get you, right? because the markets are aware of that. It's always these unexpected exogenous events where all of a sudden the yen triggers some magical level that all of a sudden the Bank of Japan says, yeah, you need to cover your shorts, and all hell breaks loose, right? That's the thing that we can't plan for it, but that's when we always have to manage risk. And that's when we talk about during rallies, rebalance your portfolio, take some profits, reduce your risk a bit. Because when markets get really overbought, you're going to have a correction at some point. And it could be a sharp, swift correction like we just had, or it can be, kind of a normal corrective event. But those always provide a better opportunity to add to portfolios later. But that's just the risk management side. But, we always get swept up into the emotions of, oh, the market's going up, I'm making so much money, I don't want to sell here because I might make some more money if I sell. And, that's the hard part is just kind of battling those emotions as we kind of go.
Well, I think that's difficult. We talked to a lot of people about their portfolios and what they have, and I've had some conversations. Maybe, hey, let's sell some of the, let's sell the ones that are up and keep the ones that are down. That may not be always what we want to do either. So we need to go through and understand exactly what you own, why you own it. Diversification. One thing I think really was good on Monday in particular is that diversification worked. Right, bonds actually rallied. We saw rates decline substantially. Now they're starting to tick back up, but as you've mentioned, I think even Monday, hey, expect rates to come back some. They're still trying to figure out. I think the encouraging part is what are we seeing? We're seeing lower highs, right, which is positive, and from a rate perspective. Now we have, and this is what's difficult too. We talk about, oh well, we should understand exactly what the Fed's going to do. Listen, the Fed doesn't know what they're going to do. They went from going to cut to, hey, we're not going to cut. And at the beginning of the year, the market expected 6 rate cuts. Then all of a sudden, magically, we got to 1. And now we have 3 potentially on the horizon, and not just quarter basis cuts. We have 50 basis point cuts, supposedly, is what the market's now beginning to price in.
Right.
And listen, the market's been wrong on the cutting.
Right.
But the market in general has still done well when you look at the indexes.
Right.
So I think that's the difficult part is that, sometimes we have to take a step back, look at what the actual market is doing. Understanding technicals, fundamentals are great. I think we can still argue they're probably not what we'd like them to be as of yet from just a stock picking perspective, because the momentum trade has been exactly what is going on at the moment.
Well, and again, as we talked a little bit about yesterday, I think we mentioned this yesterday, is that the Fed controls the 3-month Treasury bill to the 2-year Treasury bill. Much beyond that, it becomes economics that control those yields. If you take a look at the 2-year yield, it's turned sharply lower here over the course of the last really couple of weeks, which puts the Fed behind the curve. They're not really behind the curve yet. It's just that yields are moving in advance of the curve. But there was a couple of headlines out today. 2-year Treasury yield says Fed's behind the curve cutting rates. They're going to cut rates because the 2-year Treasury yield is already telling you that they're going to cut rates. So if you really want to know where rate cuts are going to be, how many rate cuts, how far they're going to go, watch the 2-year Treasury yield, because that will tell you all you need to know. And it will lead, because it's a real-time indicator of monetary policy, of what's going on in the economy, et cetera. It will tell you where Fed rate cuts are going to be over the course of time. So again, the Fed is going to be behind the 2-year Treasury yield. They are lagging because they only meet once a quarter, or once every 6 weeks.
6 weeks, yeah.
So, but every 6 weeks they will slowly start to catch up with where their 2-year yield is. So just pay attention to that, and you'll be okay.
Well, and I think the thing is that we're expecting some type of big recession. And we've been, in general, I think the market or the financial media in general has been saying, hey, there's going to be a recession. There's going to be a recession. And there will be. Listen, they're not going to be able to take a recession out of the business cycle. It's not going to happen. And in fact, we can argue it's a necessary part of it. And so it lets the market recalibrate, lets the economy get back on its feet. And, typically recessions happen when we see, too little money going to too few goods and services. And we've had an interesting dynamic when we go back and look, like 2008 subprime loan crisis, 2020, shutting the economy down with COVID. Right now, we don't have one of those big events at the moment. Now, is this yen carry trade? Is it something much larger? I mean, I don't know. Lance, you can probably answer that better than I can. But there's likely something else at some point that's going to break this. Now, the Fed historically is cutting into a recession. We'll find out that, hey, we're actually in a recession. We've seen a significant slowdown. The difference I think that we have in this environment is that, think back, why did the Fed raise interest rates? It wasn't because the economy was just booming and so super hot. It was because we had COVID, right? Supply chain shut down. Inflation went way up. We saw inflation all the way over 9%.
But hold on a second. The reason we had inflation, right? You can't say, well, we shut down the economy and inflation went up without saying why we had the inflation, which was we sent everybody money to spend. So we created demand when you had no supply. So that's going to lead to inflation, right? That's just that's basic economics.
Well, it wasn't just that, right? It was actually sending people money, then saying, oh, don't worry about paying your mortgage. Well, hold on. Why are we sending people money then? Exactly. Right? That's what it should be for. And so, we can go back and armchair quarterback this all day long.
Right, but the point is too much money.
Correct.
As you said, too much money chasing too few goods.
Yeah.
That's why you had inflation.
Correct. And so we created this problem. It wasn't like that we just saw this astronomical economic growth. It was an issue that was created by us, right? By the government as far as the stimulus and the reaction to the pandemic. So now this is a little bit different. They've held these rates for a significant period of time. I think we could consider this as far as with rates. They held them low forever. Then we've actually finally gotten back to, if we look at this historically, these rates aren't anything that's astronomical either.
Right.
These rates aren't extremely high. This is not the 1970s. I can't tell you how many times I've heard that. This is 1970, 1980 all over again. Like you were young. I'm like, yeah, I was, but I can read. And I know what happened back then. I mean,
that's the funniest line I've heard this morning.
Well, but you've got to study this stuff, right?
Trust me, I was sitting in the gas lines with my dad in the 1970s. So, gas was almost $1 a gallon. It was outrageous. Gas was so bad. This is, you have to love Texans, and you have to love Texans back in the 70s because we didn't really know better much of anything. But this is back in the day when, so you have gas lines at the gas station. Brent will remember this. And so my dad decides, and this was the thing going around at the time, you take a big propane tank and you stick it in the back of your truck and make the connection to your car so that you have propane-fueled engines because propane was cheaper than gas. You were a mobile bomb, but you didn't have to pay for gas.
Oh, man. And this is back in the day with no seatbelts or putting kids in laundry baskets and all the rest of stuff.
Exactly. And, you sat in the back of the car window, right? Or you rode around the back of the pickup truck.
Yeah.
Yeah.
But maybe these times are different, right? And listen, there's been a significant, I'm not discounting the amount of inflation that we've seen. It was significant. It was something that people and households are struggling with. We look at this, we look at, going back to credit card balances, going back to just the average Joe and trying to make ends meet. I'm visiting with a lot of people and updating financial plans, and almost every single person says, I don't know how things are so expensive. I don't think it's 9% or 10% or whatever the number may be. Mm-hmm. I feel like it's 25% because I'm going back and looking at my expenses and they have gone up considerably. And these are people with means. So think about the people that don't have that. So there are some things I think to be concerned about. We've talked about retail sales declining, should be declining, but we talked about credit card balances going up since October of 23, almost 1 year ago now, which is crazy to think how time is flying. But we haven't really seen we've seen the cause of it, but we haven't seen, what comes from it at the end of the day, right? And maybe that doesn't come. Maybe we continue they lower rates at just the right time. We skirt this recession that's quote unquote here, or maybe not. And I think that's the dilemma. Mm-hmm. And so the Fed, I think the market is banking that the Fed gets this perfect. And maybe they do.
Right. Well, they never have. But,
Well, they have, but it's typically it just pushes it off further down the road.
Yeah. So, and again, everybody wants to point back to 1995 as an example of when the Fed cut rates and it was a soft landing.
Yep.
The problem with that whole narrative is that we track 10 different yield curves to determine, risk of recession, those type of things. 1995, 1996, 1997, not one single yield curve was inverted. There was, yes, the Fed cut rates slightly, cut it like twice. But there was no evidence of any recessionary onset. In 1998, yield curves began to reverse. The Fed began to cut rates. 2000, you had the recession. So what's important to understand is that when the Fed's cutting rates and you have yield curves that are uninverting, that's your risk of recession, which we have those ingredients now. By the way, our chat says that my camera quality is worse than Danny. That's because of the model. It's not the camera. Camera's completely fine. So, all right, be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Now, I warned y'all about the chat rules. Our chat member, Jerome Powell, says that I'm old enough to remember when we used to use well oil for fuel.
Those are fighting words.
The Real Investment Show podcast.
Them's fighting words. But more importantly, what Jerome Powell doesn't understand is that I remember when we had to catch our own whale.
And then turn it into oil.
And then turn it into oil for fuel. So, I mean, that was back then when men were men.
We liked it.
At realinvestmentadvice.com.
Had blubber for days.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. It is only 6:33. Goodness. Seems like it's already been all day. It's a Wednesday. So look, so talk a little bit about the Fed cutting rates, recession. Look, there's lots of concerns out there. In our chat, somebody posted that Harry Dent, is predicting a 94% crash in the market.
Harry Dent's been predicting a 94% crash for the last 20 years.
I know. And the thing is that if we have a 94% crash in the market, ain't nothing else going to matter. I mean, literally, you better have guns and ammo because there's going to be rioting in the streets, and it's going to be terrible. So, I mean, if we have a 94% crash, things have gone terribly wrong everywhere.
Well, think about
not
this.
just in the U.S.
Yeah, but let's put that in perspective. So if you have a 94% crash, think about what we're investing in. We're investing in companies. We're investing in people that we're going to continue to spend money there. We're going to need goods and services.
Unless you have complete economic Armageddon, right? I'm talking about, this is nuclear bombs everywhere and ain't nothing working.
So essentially that's what he's alluding to.
Correct.
If you have a market cap now of, 6% of what we are today. Now, are we lofty? Yeah, we can make a pretty good argument that things are certainly elevated. Now, with that being said, though, I did watch, it was either Harry Dent, or I'm almost positive it was Harry Dent. This was several years ago on CNBC, probably longer than that. And they had him on air. And finally, the host called him out, says, you know what? You've been on this show 28 times. And every time you said the sky is falling. And someday you're going to be right. And everybody's going to be like, oh, Harry Dent called this. Mm-hmm. But I'm going to remind everybody about all the other times that you were on and how many years you've been saying this was going to happen.
Right.
So, listen, I think it's understood that we want to, oh, shoot, that's a big headline. Harry Dent's called some things correct in the past. He has. Mm-hmm. But at the same token, what are the true odds of that actually happening? I'd probably say 94% decline in the market is pretty slim. I mean, we're going to see, we've got circuit breakers at 7%.
Right. And I'm just saying, look, you just have to put this into economic terms. If the market, you hit the nail on the head, which is, if there's going to be a 94% decline in the stock market. And again, what he's looking back at and making that prediction is 1929, where there was an 89% crash in the markets. But look at what happened to the economy in 1929. The homelessness, the joblessness, everything that went on. I mean, it was complete decimation of the U.S. economy during that crash. And, it was World War II that drug us out of it. But so if you're wanting that type of event, you better have a bunker prepared somewhere, stocked up full of food, ammo, guns, and whatever, because there's not going to be a market for anything at that point. It will be a depression at that point because, as Danny rightly said, this is about companies. You're talking about the demise. Apple won't be around anymore. ExxonMobil won't be around anymore. These companies will be gone in a 94% crash because you're talking about a complete economic meltdown. So, and the rioting and the death and everything that will occur around that. And this is what always gets me about people that kind of root for these things. It's like, oh, I'm just going to sit here and cash. I'm going to wait for the big crash. Okay, well, first of all, we talked about before, even if the crash comes, you won't buy because you'll think a bigger crash is going to come. That's just the psychological factor of it. But again, why would you wish on that? Because it's not just the crash of the market. This doesn't happen in isolation. If the market crashes to a huge degree, I mean, just think about the financial crisis. We were down 50% in the financial crisis. How many people lost their homes, their jobs? How many people lost their financial wealth? All of it. To a lot of cases.
I mean, there were a lot of people that did.
Yeah.
I mean, that was devastating. I don't think people quite understand that the financial system was on the brink of extinction. Mm-hmm. I mean, that's how bad it was. The systemic risk between all these different institutions was terrible and so much leverage. And I get that we can make those arguments today that there's still a lot of those things that are out there. It'll look different. It's not the subprime lending now. Now right. It'll be whatever the next thing is. But at the same token, as bad as that was, down 51%? Mm-hmm. Everything got better. Right. We were able to get back out of it. And that's where I'm optimistic. Listen, I'm not saying that or discounting that there's going to be some type of, devastation at some point in the markets because, look, I think we all have to believe that there will be, just looking at history, going back. Mm-hmm. At some point there will. At some point we will have a recession. We'll have these things. But we build these out in financial plans. Now, listen, I have never built one out for a 94% decline in the markets. But, like Lance mentioned, a couple segments ago, hey, bet it's been a crazy couple days. Yeah, absolutely. But I think most of our clients understand that we've been expecting something. A pullback is normal. Now, do we get to something bigger? Possibly. But can your plan withstand it? That is what I think people need to put front and center and focus on. Can your financial plan, what you want to accomplish, your goals, your dreams, your wishes, can you still do those things? And if not, what does it look like? Are you eating, a box of sardines and beanie weenies, or can you still go do things and live a nice lifestyle? And I can tell you right now, my clients have been in a good situation because every single one of them, even going back to bigger crashes, because of the way we do planning, has been okay. We haven't had to go back and say, all right, you know what? The market's down, you're down X. This isn't going to work anymore. Now, I heard from a lot of folks back in like 22 who, I'd have clients say, hey, will you talk to my brother, my coworker? They're down 30, 40%. Their plan does not work. Well, their plan never assumed for a bad market. The plan never assumed for lower yields. Their plan never assumed for, a crash. So when that happens, their plan's blown up. But if you've been doing these things, and which I know most of you out there are doing, then I'm going to be okay. So what we don't want somebody who can't sleep at night because you're like, oh my gosh. And there will become a time, you think about, we talk about how sometimes these things are self-fulfilling prophecies where we talk our way into a recession, right? Because if everybody feels bad or you start seeing somebody out of a job, right? A loved one, a neighbor, you're like, oh shoot.
Well, in our chat right now, they're talking about a bit about the 2000 crash as well. That was just as devastating. Now, it wasn't to the degree that we saw during the financial crisis, because in the financial crisis, people were losing their homes because of the mortgages, right? They took on mortgages they couldn't afford, and so people were being ousted out of their homes. But there was still a lot of financial devastation even during the dot-com crash. Now, a lot of those companies that crashed, the NASDAQ was down like 70%, the S&P was down 50%. But a lot of those companies were up-and-coming dot-com companies that had no earnings, no revenue, and they blew up. But trust me, I dealt with hundreds and hundreds of people personally that had, had gone onto credit card debt to trade tech stocks and dot-com stocks. And had this one poor lady, she came to me, she goes, I've lost all my money in the markets. Let's take a look at your portfolio. And she owned every dot-com stock there was, right? And they'd all gone down 60, 70, 80, 90%. And she had lost all of her money. The problem was she was $350,000 in credit card debt because she had been using credit cards and leveraging credit cards to invest into the financial markets. So when the market blew up, it completely devastated her. I'm like, I'm sorry to tell you this, but you only have one option. You have to file for bankruptcy. You're not fixing this ever. But so don't dismiss that there wasn't a lot of financial devastation in the dot-com crash. There was, but it was more isolated to the economy. Some people may or may not know the story of Enron. Enron was local to Houston, Texas, where Danny and I reside. But that entire company went bankrupt. Thousands of people lost their jobs. A lot of those people had their entire 401k plan in Enron stock. They literally lost everything. They had nothing else once that crash occurred. WorldCom, Global Crossing, et cetera. WorldCom was a huge company at the time. WorldCom MCI, telecom company, blew up, right? It's no longer here anymore. So
yeah, but everything you're saying right now can be prevented, right? Because we're talking about putting all of your funds in one spot. And I don't mean like in one custodian. If it's at Fidelity, Vanguard, Schwab, whoever. What I'm talking about is more along the lines of like one stock, one company. You're betting everything on one horse here. And something happens, that's when it's devastating. And so, when you talk about risk management, I think it's got to be a little bit of many different things. And then having an understanding in that discipline, but understanding also within that plan, I think that's very, very helpful. 2001, 2, and 3 were really interesting, right? Because it wasn't like you had this 30, 40, 50% decline in markets all at once. It was, a little bit each year and, okay, things will get a little bit better. I can remember when I just started in the industry.
That was like 6 weeks ago, by the way.
It was literally 6 weeks ago.
Congratulations on passing your test.
Thank you. Yeah. Thank you. So, but I passed my test, and they're like, "Hey, here's some funds, and here's a stock list to go sell." And I'm like, "What?" And it was like the Wild West back then. I feel like compared to where things are today. And they're like, "Yeah." I was like, "Well, what do you mean?" They're like, "Well, just go look at the ones with the best returns, and just call these people and tell them they need to buy some." And you go back, and it was all those big startups, right? It was all the tech. It was those AIM investments, if you remember those back then, that were very, very, they were out of Houston, a very tech-oriented company. And that's where I think people got in trouble. You're seeing people back then who were going and doing home equity loans just to go and say, hey, they're betting on the market just for the speculative aspect of it. Oh, this can't go down. It'll continue to go up. And then we saw that once again, from 2004 to, 2008.
Yeah. And again, this is always the case. And look, we're in one of those cycles now. I mean, investors are very, very exuberant about markets. And even with this crash, people are very quickly jumping back into the markets over the last day or two. I'm getting a lot of emails like, time to buy, is it time to get in? It's interesting. We used to have the fear of missing out, which was people trying to buy the highs as markets going up. We have the fear of missing bottoms now. And so every time we have a correction, people can't wait to get in and buy. Eventually, that's not going to work. And you are going to have a bigger correction that'll eventually wipe out some of this more speculative investment. That'll be your opportunity to really start buying the market. We're not there yet. So again, we haven't changed that dynamic. There's still a lot of greed in the market. We'll talk a little bit more about this on the other side of the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So yeah, let's talk a little bit about sentiment here because I think that's kind of an important aspect of where we are currently. Again, lots of headlines here recently. I did a Ask Anything yesterday with Adam Taggart, with a couple of the other advisors that they recommend on a live chat yesterday. And it's interesting, because Adam's talking about, we've had the Sahm Rule triggered. This means a recession's coming. And that's not necessarily the case. Yes, the Sahm Rule which is, quick explanation. There's an article on the website, not surprisingly. If you go to realinvestmentadvice.com, go to our daily, go to the Insights tab, and on our daily blog, just like 3 or 4 down from the headline is an article talking about the Sahm Rule. It's just basically when the unemployment rate's 0.5% above the 12-month average. That normally has been a warning sign of a recession. But even Claudia Sahm herself has said maybe different this time. That we have a lot of other things that are going on that may not mean a recession is imminent. But we have a lot of these headlines coming out, and this was part of Adam's conversation yesterday is like, we have this risk and we have what's going on with the yen carry trade. Surely this means, a bigger bear market's coming and we need to all be prepared for that. One of the issues is that, while we do have this group of kind of more perma-bearish individuals, the general sentiment of the market is extremely bullish. And as I was saying before, when we go back to like 2020, right, coming out of that decline we had in March, all the stimulus checks hit the households, everybody jumps onto Robinhood, starts buying stocks. There was this fear of missing out. Markets were going up and everybody was piling in. Retail investors were just piling into the market because of this fear of missing out. Flip side, 2022, we're going through a drug out correction in 2022. So Russia invades Ukraine in January of 2022, and from there, the Fed's hiking rates, and we're worried about a variety of things. Potential, everybody's talking about recession risk on the horizon because the market's declining, the Fed's hiking rates, and we never had a recession, and we never really had a big drawdown in the market. The market just kind of ground lower all year. We were down about 20% by the end of the year. But every time the market declined, there was this fear of missing out on the bottom. I was getting emails from people like, is this the bottom? Is this the time to buy? That's not what you see in a real bear market. In an actual bear market, if we have one, or when we have one, I should say, in a real bear market where you're breaking trend lines, bullish trend lines, and you're starting to break psychology, investors don't want to buy the bottom. They want to just sell and get out of the markets, right? That fear of loss becomes prevalent in the markets. And so every opportunity comes to sell stocks. We don't have that right now. Right now, in 2022, we didn't have it, and today we don't have it. I'm getting emails last couple of days. Should I buy the dip, right? That fear of missing out on the bottom is still there. I don't want to miss the bottom. This is my opportunity to get in. Look at what the market's done over the last 10 years, and I've missed it this whole time. I don't want to miss out this time, so I got to buy this dip. Is this the time to buy? That type of sentiment, you've got to break to have a much bigger bear market decline. Will it happen? Eventually, yes. But that's not right now. Because again, and look, and as I said at the beginning of the show, we're not, this bottom we put in on Monday is likely not the bottom yet. That doesn't mean we're going to go lower, but a bit of a rally here. These trap longs want to get out. They sell. Markets come down a bit, retest recent lows, maybe set a higher low, and that'll probably be your opportunity to add some money to the markets for right now. But again, we've got a lot of challenges as we go forward. But again, the bullish sentiment, allocations to markets, the bullish sentiment, the bullish appetite, that is still very, very strong right now. The force is with you. But that's kind of where we are at the moment. And that's going to last for a while. So again, be a little cautious, as we said before. There'll be a time to be bearish, right? There'll be indications as time to be much more bearish with your allocations, to be much more conservative, have much higher cash levels, and don't think we're not risk averse, because we are. We're carrying 16% cash right now. We're only 53% equities out of a potential total of 70. Our bonds are underweight our duration mark, so we're still cautiously allocated, but we're allocated in a manner that leaves us comfortable enough that we can manage downturns and participate with markets going up. During this recent correction, we outperformed our benchmark by almost 2.5%. Now, doesn't mean our portfolios didn't lose money; they did, but we performed much better than our benchmark because of our risk weightings in our portfolios.
But I think, you mentioned something. You've got to have some level of cash if you want to be able to participate and actually buy that dip. The key, though, is that also having some allocated to the markets as well, because this will remain, what you may believe is irrational longer than you can probably remain rational, which is now why you're trying to get back in or buy that dip. And, not to say there couldn't be, a 50% decline again. There could. But during those times, nobody's going to want to buy. And, the issue, and, I've talked to a lot of people who have come to the realization they kind of have to get out of their own way, in the sense of like, okay, I think this way, I feel this way, but man, it's just not coming to fruition, and markets are continuing to run. So I want some level of risk management. I think where we can get in trouble is, especially in an environment where we do begin to see some volatility like we're seeing now, is that we're all in or we're all out. We don't know where to get out, how to do anything different. And a lot of firms are going to say, hey, just ride it out. And you know what? If you've got time, you'll probably be okay. The issue is if you're taking distributions, you need funds, you need access to capital. You want to actually buy a dip and play the market. Well, you've got to have capital ready for that as well. And I think that's the challenge that many people are faced with, Lance, in the sense that, how do we do a little bit of both? We want to participate, we want to get that upside, but yet we want to have some insulation from the market if things go the opposite direction, and want to have that dry powder, when needed.
Right. Well, and again, this is the important case. And look, if you take 5 minutes and go review our website, go to realinvestmentadvice.com, click on the Insights tab, and go to our daily blogs, just an example, and just scroll the headlines. A lot of people mistake me for being super bullish. They're like, oh, Lance is so bullish. He's bullish all the time. No, I'm not.
Which is hilarious because for years, Lance was the complete, everybody's like, oh my gosh, Lance is such a perma bear. And I'm like, no, he's really he's a nice guy. He's kind of optimistic. I mean, he's a little grumpy sometimes, but, he's not as bad as you think. Yeah. And now you're the opposite. Everybody says, look how bear or bullish Lance is. It's like, it's like an alternate universe if you've known Lance for any long period of time.
But again, if you just go read our headlines, there's plenty of articles that we've written about recession risk, risk to markets, risk to the economy, credit risk, all these type of things. We publish our research for you. So, the blogs that we write, our weekly newsletter. And if you're not taking advantage of if you're watching our YouTube channel, that's great. Appreciate you being here. I'm so glad you're here. We really enjoy you. Please like and subscribe to the channel. Please comment, join into the chat with all these other yahoos over here. But just teasing, we love all of you. But you're really missing a big resource because the research that Mike and I and Nick and Danny and Richard do, we publish it. We write it down and we publish it. So there is the support for the decisions that we're making. Why are we saying certain things? Why are we investing a certain way? We publish all of our research for you. So if you want to know kind of what our views are, there's a whole library of daily, we publish blogs 3 to 4 times a week, weekly newsletter, daily market commentary that has a trading update in it every day about what we think the markets are going to do. So again, all this is there for you to help you navigate and manage your own portfolio better and manage that psychology risk, right? But I'm not uber bullish and I'm not uber bearish. We're just trying to analyze the data for what it is and navigate the markets for what we have. And, as we talked about before, if you're bullish or if you're bearish, that traps you into a certain way of thinking. And so we try to battle that all the time. I've said before on the show, I'm very conservative personally, right? And I lean more towards the bearish side of things. That's my natural tendency. So it's a challenge to be optimistic. A lot of times in the market's like, hey, this market's going to go up. I know this thing's overvalued, but we got to own it because it's going up in value and we have to participate in the markets and we have to create returns. And that's our job. It was interesting in the chat yesterday. I was being, people in the chat with the video I was doing with Adam yesterday, they're like, oh, Lance is just talking his book. He's this, he's that, he's this other thing. No, we have a job. He's like, if you give Lance money, he's got to invest it. And I was like, no, I don't. We don't have to invest money, and we don't invest money. If we get a new client today, we're not investing anybody right now.
Well, and that's funny because I've had that conversation with some clients who have funds that have come in cash or even some that are invested. And we're like, okay, hey, let's just see how this kind of plays out over the next couple of weeks here. And we'll begin to make some changes and obviously clean up some things when need be. But that's a big question because people are like, what do I do? How do I go ahead and step into this market? Or how do I begin to kind of extract some funds if I'm fully allocated? And so we have a lot of clients that come in just like that. And we don't have to just go out and say, boom, you're automatically invested. And that is a blessing and a curse. It's a curse if somebody's in cash and the market just runs. But if we're doing our job from a risk management perspective, we may have positions that we own that we don't want you in right now because we may be about to sell something or we want to step into it slowly. And so, we have the liberty to do so. Now, it makes our job much more difficult. I mean, it would be a lot easier if we could just say, money's here, let's flip the switch, fully invested. But that's not how we manage.
Like every other advisor does?
Like most,
exactly.
Like most. But it's also, if we're going to actually physically manage that risk and allocate appropriately at times, there's good and there's bad to it. But, on the other side of it, if things go bad, I think we're in a much better situation.
There you go. All right. Hey, look, we appreciate you very much. If you're in Florida right now listening, I saw a couple of our comments. Our hearts are with you during the hurricane and, actually tropical storm now with Debbie. We just went through Beryl here, so we can certainly sympathize with you. We hope all is well with you. But if you have any issues, questions, comments, whatever, don't feel free to reach out. Email us at our website, realinvestmentadvice.com. More than happy to help. And like I said, if you haven't taken advantage of our resources, do it. It's on the website. It's all free. We'll see you back here tomorrow.